Hello, mortgage fans. So we're back for another mortgage market update. And this week I have with me Mr. Nick Plappert. How are you?
Yeah, very well, thank you. It's Friday, sun's shining, so can't complain.
Not bad at all. Not bad, is it? So
Yeah,
what I thought we'd talk about today is the Bank of England met yesterday. They raised rates again as anticipated. So the base rate has now gone up to 1% from where it was at sort of 0.75. So I thought it was worth just having a conversation around that and sort of kicking off sort of the key themes that we talk about probably day in, day out with our clients. So how does that sound?
yeah, that's absolutely fine. Yeah, more than happy to talk.
Cool. Right. So first, very obvious question. So the base rate's now at 1%. How high do you think rates will go, and over what sort of time frame?
Yeah, it's said rates now the highest in 13 years, which is a long time, and trajectory is certainly for them to keep increasing. Inflation is not going anywhere. The forecast for inflation keeps going up as well. I think it's 9% now by the end of the year, rather than 7% literally a month or so ago. So unfortunately, base rate will have to keep going up. I think by the summer, in a couple of months, I think we'll certainly be at 1.25, perhaps 1.5. By the end of the year, it could be 2% by the end of the year. That has been spoken about. But I think my feeling is that when it gets to 2%, whether that's end of the year or by next spring, I think it will probably level off, potentially at that level for a bit. And I think inflation is expected to come back down next year. And if that happens, then they could perhaps leave it at 2% for a time. But that's my sort of feeling. But it's very hard to predict with what's going on in Russia and the cost of living. But that's sort of where I think things are at the moment.
Yeah, no, I think it's a really, really good summary. My thoughts are very much aligned with yours. I think what we're sort of seeing, and you touched on the key thing there, is inflation. It just keeps going up. A lot of people think real inflation is running at near 10%, so rather than the sort of 6% that's sort of measured at the minute. Out of interest, as you know, I'm a geek, Nick. I've looked at sort of money markets this morning, obviously at the back of the Bank of England movement. So 2-year money is at 2.31%, 5-year money is at 2.17%. And 3-month sterling LIBOR is 1.29%, which pretty much bangs straight onto what you were saying there. So the 3-month LIBOR, that's sort of indicating that the base rate will go up again when the Bank of England meet next month, but then there's not a month meeting the month after. So I agree. I think probably end of this year into next, we could easily see 2%. I think 2% was talked about as a new norm for quite some time. It looks like it might creep a bit north of that now. And it's something I'm going to talk about probably we'll come on to in a bit actually. But I know Rishi Sunak threw his hat into the ring, didn't he? Sort of saying that he thinks the base rate will go to 2.5%, which seemed punchy.
I think I put the jitters in a lot of people as well, him saying that, because it have a massive impact on people, with the cost of living going up, and then suddenly, a base rate going from 0.1% to 2% in a short space of time. That's going to have a real impact on people. So it's a very fine balancing act. I really wouldn't want to be the Bank of England at the moment making these decisions.
No, I mean, it's such a difficult balance because, as you say, like inflation is the big thing, and that's then creating the cost of living squeeze. But you quite rightfully mentioned again, a lot of the issues are global. You mentioned the supply chain issues, Ukraine, Russia, big issue. So lots of things you sort of could argue, well, you can raise the base rate all you want, it's not going to change it. So it's a really, really difficult dynamic. So we'll probably come back to that as a bit of a topic, but specifically keeping it on rates and obviously what we do for a living around mortgages. Have you seen a spate of lenders change their products off the back of this, or how have banks responded so far?
Well, what banks do at the moment is the rates are changing every single week. Notching up every single week. Sometimes it's by 10 basis points, sometimes 30 basis points. And we did see some rates increases yesterday, but not anything different than the past 2-3 months. So the rates just keep going up. But this is not necessarily, I don't think, to do with the cost of funds. A lot of it is this cycle that we're in where the mortgage market is very busy. When a lender's at the top of the list for pricing, they get too much business. In order to turn the taps off, they have to increase rates, and the next person goes up to the top. And that's the cycle that we had before and the cycle that we're in now. It happens the other way as well. When rates cut, they do the same thing. So while the base rate's increasing, I still think we're going to get rate increases, as we are. It's not going to change.
No, absolutely bang on. And again, I think it's probably a bit of a misperception for a lot of certainly our clients that they think the Bank of England moves rates and then mortgage lenders change their rates. It doesn't work like that. These changes have been so widely anticipated, they've already done it. And as you say, it's just at the moment, everything just creeps up and up and up, week on week, month on month, just by little bits here and there. So you don't get these cliff edge movements. Mortgage funding doesn't really work like that. You tend to get that. Banks look what's happening in the future, price it, and then adjust accordingly. Tends to be what happens. But I think again you've hit the nail on the head, and I think probably one of the biggest factors why there's been so many rate changes, so not necessarily rates going up, banks changing the product so quickly, is as you say, whoever's cheapest gets hammered with business, then has to pull back. So it's I sort of feel a bit like it's sort of like whack-a-mole at the minute, because I'm not sure if you're in this situation. You recommend a product to a client on a Monday, for example, right? Here's the best product for you. They get a few documents together, ready to go by Wednesday. It's already a different lender by that point.
Yeah.
But the product itself may not be majorly different, but it's a different lender, and it's it's invariably marginally more expensive. But it's tough to keep track of all this stuff at the minute.
Yeah, it's changed the way we had to work, because previously you do a decision in principle with Barclays for somebody because they were the best rate, and that would stay there for weeks. There's no point in doing a decision or agreement in principle for a client now, because it will be a different bank by the time you actually go ahead. So we have to work. We have to sort of adapt and then work differently, basically.
No, I completely agree. And again, if you're talking specific pricing, no, you can't sort of if someone's like looking for a property, you just can't predict who's going to be the cheapest when they come to buy. I still think if someone's got a complicated situation, it makes sense to get an AIP because someone wants to know the maximum they can lend, or it's a bit more complicated. I still think there's a lot of validity in that. But talking just purely around rate, you're absolutely spot on. And sort of closely linked to that, so obviously rates moving, banks doing a lot of stuff. Have you seen any material change in lender criteria? Is it getting worse, better, indifferent? What's your experience of how lenders responded from a criteria perspective, so not pricing?
Yeah, well, from a criteria, we've actually seen lenders looking to lend more money. There's more lenders now doing 5.5 times income than there was about a year ago. However, on the other side of the coin, what the banks are now doing is factoring in the increased cost of living. So I recently found out that Santander changed their affordability calculator basically now to factor in cost of living with the ONS data. So it's actually in some instances now they're not lending as much as they were about 3-4 months ago. Yeah. So what
sort of pricing? So are they clients who earn more or less money? Where's
no, that's for clients earning. They were only over 100,000. But whereas before they were lending even up to 85%, 5.5 times income, they're now doing that, but a lower loan to value when you're sort of looking at the calculation for the income. And they've just changed that very recently. So we've seen that from not all the lenders, but but one particular bank, Santander. Otherwise, criteria is pretty. There's not been major changes. Banks, there's still plenty of appetite to lend. So that's not changed in that side of things.
No, I agree. So again, from what I'm seeing is, I wouldn't say lending criteria is getting looser, but certainly there's no tightening, put it that way.
No tightening. Not like it was when COVID hit. There was a massive tightening. But no, that's not the case. If anything, they're looking to lend more and be more flexible. To a degree. So
I certainly think we're sort of back to the pre-COVID sort of lending criteria now. It's that sort of like 100%. You say, quite a lot of lenders go to 5.5 times income. You can still get a mortgage with a 5-10% deposit, that sort of stuff. So all that stuff's back on the table. So I'm not seeing any material change, and I'm not surprised. Like you, in certain instances, because lenders' affordability tools are quite complicated these days. They'll factor things like if you've got children, if you've got debts, for example. So I think that's where it's going to pinch people. I think if you're probably like a single couple, no debts, no children, single couple, couple that children, I think you probably still get up to those higher levels. But I think if you do have debts and children and those sorts of things, I think that's where you're going to feel a little pinch on, are banks going to go to 5.5 times income, or would they come back a little bit? So I think it's quite a logical thing for lenders to do. Yeah,
absolutely. Cost of living is going up. They have to factor it in. So
absolutely. Well, talking about that takes me beautifully onto my last question, actually, Nick. So obviously, huge talk. I read a few write-ups on the way home last night on the Bank of England base rate rise, and the R word was everywhere. So
right,
it's
yeah.
all doom and gloom. Recession, it's coming, it's over. And it always reminds me of capital economics, if you remember back in the day, pre-crash, Nick, where they've called the last 10 of the last 2 recessions. So I appreciate people who do sort of fearmonger, and I think there's always an element of sort of clickbait around, sort of fear sells, and so there's always a bit of that. So, but in reality, then, do you think a recession is likely? And even if there is, because we're not economists, let's be honest, but even if we do tip into that territory, do you think that's going to have a material impact in the mortgage and property world?
Well, no, not necessarily. I mean, by definition, a recession is 2 quarters of negative growth. That's basically it. But what is more important in the mortgage market is the underlying supply and demand. And over the last, especially since COVID, the supply and demand margin has got bigger. The demand has, if anything, got more. But the supply of new properties has become less. They were building less over COVID. So, I don't think the demand. Maybe there'll be a slight drop in demand, cost of living, all this stuff. A few fears on what's happening in Russia, but overall, I think the demand will still stay up. And there's a massive lack of supply. Every agent I speak to, there's not enough stock to sell, and there's too many people looking to buy. So even if there is a recession, I don't see massive impact in the mortgage and property market. In some areas of the country, maybe more than others, but I don't think so. That's my opinion anyway.
Yeah, no, I completely agree with your last point there. It's sort of very specific as to where you are and what you do. So I won't go over the supply and demand thing, because you described that really well. I think that's the key dynamic, and that's probably not going to change anytime soon. I looked at some forecasts around sort of like a 0.25% drop in GDP this year at some point next year as well. So we're not talking 1, 2, 3, 4% drop in GDP. This is very nominal. So you might go into like a technical recession, but we're not talking 2008. It's not that sort of thing. So I don't see that happening. And when you think through what's happening, so when there's affordability squeeze, people cut back on spending. So you think the people at risk of hospitality, services, that type of thing. Let's be blunt, that's not our clients. Our clients are professionals, city workers, and I think that's why banks sort of sway more toward that at the moment. You're seeing a lot of them prefer higher earners for this reason. They're less affected by these things, and certainly the affordability squeeze and more job security. So, we're primarily London and the Southeast. That's what we do. I can't see that causing a big problem in our neck of the woods over the next couple of years, if I'm honest. It might take a bit of heat out the market, which is really hot at the minute. But I can't see it I can't see house prices going down. I can't see lenders pulling back criteria. I don't see that happening right now. I think things would need to change materially for me to change my opinion on that at the moment.
Yeah, exactly. I mean, we look at what we've all weathered with the COVID. When that struck and how much of a major impact that had, but then bounced back so quickly. I don't think with what's coming over the next year or so will have a massive sort of impact, really, personally. But we'll have to see. A lot can change, but
like I said, I think in other parts of the country and in other demographics, I think there could be real issues. So it's not to say that this isn't a real thing. I think some real people have some real problems, but thankfully or whatever, that's probably not going to be us or our clients, thankfully. So I think that pretty much wraps it up for us. So thanks for your time, Nick. Really insightful as always. So if anything sort of talked about today is of interest, get into contact with Nick, myself, anyone on the team. This is what we do. We spend a lot of time digesting this stuff so that we can give you the best advice, save you the most money, and then ultimately get your mortgage paid off as soon as possible. Because let's be blunt, no one wants a mortgage. So we're here to help you get rid of that. That's what we do. So
especially when they get more expensive.
Well, exactly. So So I mean, we could start a whole nother conversation around that. But so thanks again for your time, Nick. Absolute pleasure, and we'll catch up soon.
Cool. Thank you very much. Have a good day. Cheers.